All right, it's 4:01 Eastern, so we'll go ahead and get started. Welcome, and thank you for joining the quarterly CKE Financial Services third quarter quarterly market update. We like to do these calls for our clients and investors to provide timely information so that they can make good investment decisions that may be impacting their investments or their financial planning goals. So with that, I'm Scott Jones. Ryan Ironman as well is going to join me as we go through this. This should be about 30 minutes. If you would like to ask a question, there's a Q&A on the Zoom channel. Just type it in and we'll try to answer them at the end. We usually do record these calls, so we'll send out a recording link, as well as if you would like copies of the slide deck, we're happy to share that with you as well. So let's go ahead and get started. So for those of you who don't know us, we're CKE Financial Services team. We're based in Westlake, Ohio. We're missing our third musketeer today, Brian, who usually hosts these calls. His daughter is actually in the second round of volleyball playoffs, so we're wishing her well and hoping they can bring home a victory today. But Ryan and I will go through the presentation today. And our contact information is available as well. Some of our services that we provide, we do these quarterly market update calls that we're attending today. You may be joining us because you're an individual investor with us, or you may be an employee of one of the companies that we help advise on the 401k plan. So again, just appreciate you attending and being a client of ours. We do one-on-one meetings. We sometimes do those in person, as well as we make them available via Zoom. And we do on-site group education meetings. Also, we provide some additional financial planning tools and newsletters that you can sign up for. So with that, let's take a look at the agenda. Usually, we try to go through some key themes, stock market outlook, bond market outlook, and just the importance of diversification. I always say there's usually three major investments when you're thinking about long-term financial planning. Specifically for retirement, you usually have stocks, bonds, and cash. And so we like to give a stock and bond market update because it's probably, the biggest chunk of our portfolio. There are other things that you can invest in that you hear about, but generally speaking, stocks and bonds and cash are going to make up the biggest percentage of our portfolios. So that's why it's so timely that we provide updates there. I'm going to hand it over to Ryan, who's going to kind of go through some of the market update, and then I'll come back and finish up on the bond market as well as diversification topics. But as you can imagine, we have a few weeks left till the election kicks off. So it's probably the most important topic that we're getting questions on. So I would say we're going to spend some time just giving you some history of markets during different political parties, who's in charge. Hopefully that'll help you ease any concerns that you might have, just looking at things from a historical perspective. But definitely the election, as well as interest rates and inflation, tend to be the key topics that are driving market conversation, investment conversations at this time. So with that, Ryan, I'll hand it over to you, and then if you want to go through the key themes and then stock market outlook, I'll come back with the bond market. Okay.
All right. Sounds good, Scott. Thank you. All right. So to kick it off here, like Scott mentioned, I'm going to touch on the key themes that we're seeing so far in third quarter. The first big one is trade and tariffs and the impact on consumers. Our thoughts there, as far as Raymond James is concerned, is historically, tariffs are meant to protect domestic producers from foreign competition. However, what we've been actually seeing is the tariffs that are in place, that were put in place during Trump and have continued under Biden, are having the impact of actually raising prices on consumers, and then also making it a lot of things more expensive for businesses and capital expenditures. So our take there is that, as far as like a trade war is concerned, we're hoping that we can avoid that in the near term. The elections are another big topic that is on everyone's mind. And the big key theme here is that throughout history, no matter which party ends up winning, whether it be Republican or Democrat, the markets tend to do their thing, and the S&P 500 and the markets overall tend to continue to perform well despite who ends up winning in November. And then the last theme here is the yield curve inversion, which historically this inverted yield curve, when the 10-year Treasury yield is lower than the shorter term 2-year yield, historically that has predicted a recession. Actually, nine of the last recessions have been predicted by the inverted yield curve. But this time, even though we've seen an inverted curve over the past 2 years here, we're thinking that we're not going to see a recession this time around, and we'll share some of the reasons why we think that. And so moving on here, these are some of the stats that we have seen throughout third quarter, just to give you a summary of what happened before we look into what's coming down the pipeline. The Dow Jones Industrial Average in third quarter, the return was 8.21%, and the 12-month return there was 26.33%. If you look at the S&P 500 index, the third quarter return there was 5.53%, and the 12-month return was 34.38%. A few other key items to note here: the Fed funds rate is starting to come down. The target range there as of 9/30 was 4.75 to 5.0. We expect to see another 50 basis point reduction in 2024, and then we expect a few more cuts in 2025 as well, targeting, I believe, 3% is what we're expecting. The 2-year Treasury 3.64, 10-year Treasury 3.79. Like I mentioned on the last slide, that we've seen that inverted yield curve for about 2 years now, and now it's finally flipped to a normal curve there. And then gold, the third quarter returns there 13.67%, and then the 12-month return 42.51%. Over on the right, you can see our sector weightings, and right now we're favoring information technology, healthcare, and industrials. And a couple quick reasons for that. Information technology, AI, continues to be the driving factor there, and we see that as a buying opportunity, particularly with the generative AI. We think we'll see downstream benefits to semiconductors, and then even further downstream, seeing benefits continuing for software and hardware. Healthcare is an industry that tends to perform well just following rate cuts, so look out for that. And then industrials, we're seeing a lot of investment there due to the fiscal spending with the Inflation Reduction Act and the CHIPS Act. So To get back to the election theme here, this is a chart from Capital Group that looks at the history of the markets in reference to the elections going back to 1933. And you can see here that the red shows when a Republican was elected, and the blue shows when a Democrat was elected. And this tracks a $1,000 investment. If you were to make a $1,000 investment all the way back in 1933, what would that have come out to as of 2023? So just a year ago. And so that $1,000 would be worth 21 million as of December 31st, 2023. So this pretty clearly shows that regardless of who ultimately wins the election, that the stock markets continue and have continued to go up. Similarly here, this is another chart from Capital Group, and it's kind of hard to see the details here, but it's tracking all of the major events throughout history. And this also goes back all the way to 1936, and tracks the returns of the S&P 500. If you were to invest a hypothetical $10,000 all the way back in 1936, that $10,000 would now be worth $119,786,000. So yeah, so as you can see there, throughout the history of Republican and Democrat presidents, we have Ronald Reagan there, George Bush Sr., Bill Clinton. The trend is still that the markets continue to climb, and overall, it's averaged, at least the S&P has averaged about 11% over that time period. The last piece on the election that I'll share is this is an interesting one. It looks at 20 election years going back to 1936, and if you were to invest $10,000 at the beginning of the election year, so January 1st of 2024, what would that $10,000 be worth after 10 years of being in the markets? And in 20 out of 20 instances, you would have had a positive return had you invested in an election year. And then 18 out of 20 of those years, you would have actually ended up doubling your money. So I think, one of the standouts here is, like, if you look at 2000 to 2010, in that period, that was the one instance where you wouldn't have doubled your money, although it was still a positive return. And during that time, you had the tech bubble, the 9/11, and the financial crisis, all in that 10 years there, and you still had a positive return. So that's a pretty interesting one. Moving on here, we touch on this one a lot. This is the S&P 500 returns going back to 1980. And as you can see, the gray bars there are where the market ended up for the year, where it finished. And then all of the red dots below the line are the low point of the markets during that year. So what this is demonstrating is that despite each year there being a pretty significant sell-off, in fact, the average is 14.2%. There's a 14.2% sell-off average each year. The markets tend to finish up. And as you can see, this year to date, we're up 21%. And over the course of time, the markets finish up about 75% of the time. And overall, I think I mentioned in a previous slide, but the S&P tends to average about 10%, 10.3% per year. This chart looks at the PE ratios of the S&P 500, and that stands for the price to earnings ratio. And this is a stat that lets us kind of look at the valuation of the stock market over time. Gives us an idea of whether the stock market as a whole is overpriced or underpriced. And the historical average is about 16.73%. So as you can see, at times in the past, such as in 1998, 1999, we've seen price to earnings ratio multiples as high as 24 times. And then as low as in 08, eight times multiples. So then if you look at the current, where it's currently at, we're at a 21.52 multiple there. So this is just one statistic to consider, but maybe a sign that the markets are slightly overpriced compared to the historical average. And then the last slide I'll touch on here is our prediction for the 12 months out. If you look in the top right corner, you'll see that our prediction for the S&P is 5850, 12 months out. Now we have already just about hit that number. So we're kind of expecting things to be pretty flat the rest of the year and into next year. But we're expecting the bull market to continue, and a couple of just charts to give you some of the reasons why we think that. Inflation slowing down, as you can see on the left there. Finally, CPI has gotten into the 2s, and then core inflation is still in the 3s, but it's coming down consistently, which is a good sign for higher multiples. And then the chart in the middle there is showing that there's still a record amount of cash in the economy that is not invested. And what we typically see down the line when that's the case is that money eventually works its way into the economy, which would be a further benefit to growth. And then with that, I will pass it back to Scott to talk more about the fixed income markets.
Awesome. Thanks, Ryan. So yeah, let's just go ahead and transition into our bond market outlook. A similar chart to what Ryan showed on the S&P 500. This is actually what we refer to as kind of a bond index. It's a Bloomberg U.S. aggregate index. And so the annual returns here you can see are, pretty consistent year to year, although we've had a fair amount of volatility over the last couple of years. The average return here since 1976 is about 6.6% down there at the bottom of the screen. You can see the red dots though, they're pretty tight. There's not a lot of volatility going on here. And we've had positive returns in bond investments for 43 out of the last 48 years based on the bond index. And the average interior drop is about 3.5%, which is, you can see is a lot less volatile than the overall stock market. So year to date, we're up about 4% here through the third quarter. Last year we finished up 6%, but you can see the year before that in 2022 we had a huge negative, the worst year since 1976 for sure that the bond market has experienced, and we're going to talk about some of the reason for that next. So if you look at 2022, and this is the Fed, what we call the Fed funds rate, the Federal Reserve meets 8 times a year, basically to discuss, and part of those meetings to discuss what the Federal Reserve rate should be, or the Fed funds rate should be. So most recently, we just heard that there was a 50 basis point cut in the rate, and you can see that on the far right in the line coming down. And then if you look at right to the left of that, the higher spike that we saw in 2022, that was pretty much a direct result of that negative bond return that you saw in 2022. So we always like to say there's an inverse relationship between interest rates and bond prices. As interest rates go up, bond prices will go down. And sometimes it depends on how dramatic the interest rate increase, meaning speed, it is. So you saw a huge increase in the Fed funds rate rather quickly over that time in 2021, 2022, which was the result of that negative bond return. If you look towards the far right of the chart, you'll see the different colors, green and blue. That's what the market expects the Fed funds rate to be at over the next couple of years. And so Ryan mentioned what the Raymond James expectation is, and this really has a lot of implications. It could impact mortgage rates. You know, if you have somebody that you know is currently looking for a house, they're, you know, probably talking about the higher interest rate that they're having to pay for their mortgage. You know, it also impacts the rate that you're getting on your savings account at the bank. And Ryan touched on the record amount of cash, over $6 trillion, that is sitting in money market funds currently. So if the rate comes down on those money market funds, it's likely that you would see somebody say, well, I'm not so happy making 2 or 3% as I was making 5%, right? And so that money will look to find another home. And so that's going to be important. As these rates come down, the outlook for bond returns looks much more positive going forward. So this is we're going to switch gears, just talking about diversification. Obviously, when we're thinking about long-term financial goals like retirement, for example, we want to take a more balanced, diversified approach to investing. It's kind of, you hear the term, not putting all your eggs in one basket. And that's really what this chart is referring to. You see a lot of different colors. Each color represents a different type of investment that you can make. And most 401ks today probably have each one of these colors represented by a investment choice that you can make. And so you can see on the far right top, year to date, large cap stocks has been the best performing asset class investment, up 22%. And that's what we refer to a lot as the S&P 500. It was also the best returning category last year. And if you look over the last 15 years, from 2009 to 2023, is also the highest average returning asset class, 14%. So the S&P 500 has been the best place to be, and it continues to provide really strong returns. Some of that is some of the things that Ryan mentioned with the AI. You have some of these larger company stocks that you hear about that, you know, just quite frankly are making a lot of money, and investors are chasing or investing in those higher earning companies. So we'll see probably a more balanced approach as we move forward. Small caps have historically, the orange box, also performed well. You're starting to see some movement into that area at this time. But really, overall, what we want to focus on is this white box with the line, as you see, that stands for a balanced portfolio, or maybe putting 60% of stuff in the stock market, 40% in the bond market. It's diversified, and it really takes out the highs and lows from year to year. You can get, we like to say, you can get stock-like returns without taking on as much risk in your portfolio by diversifying. A couple other things on this chart that we always like to mention is the purple box, which is cash, which is up a lot higher than it has been for many years. You can see that was paying almost next to nothing when they had interest rates, 0.25%. there, but the purple box tends to finish last when you're thinking about a long-term investment. So we'll move on from that. This is another thing we like to show also, as far as when you're thinking about making an investment decision, think about how long the time horizon you have for that investment decision. You know, is this something you're going to need to sell to use to pay for something else within a year, 5 years, 10 years, or 20 plus years, and use that as a framework to kind of make your investment decision. So a lot of times we're meeting with people and helping them with their retirement goals, and that goal is usually 10 to 20 years into the future. So if we look at this chart, it's basically showing you 3 different investments: stocks in green, bonds in blue, and then a balance, what we refer to as a balanced portfolio, where that white box on the previous slide is a 60% stock, 40% bond portfolio. And if you look at all 3 of those over 20 years, meaning if you're putting money to work today and investing it, and you're not going to use it for the next 20 years, neither of those 3 have ever had a 20-year negative return. If you look at a 10-year period, there was the one time, 2000 and 2010, where we had a couple of events where you had at worst a minus 1% return in stocks, 1 to 14% return in bonds, 1 to 16% return in a balanced portfolio. So you can see the longer you go out, the less likely it is that you're going to experience a negative result from that investment. All right. So we're going to wrap up with that. And just, again, a lot of times, if you're joining us from maybe your company's 401k plan, you know that we have portfolios that we build, and you can choose a conservative to aggressive portfolio, risk-based portfolio, or there's also what are called very popular now target date funds, which are designed basically for you to invest in a fund that is targeting a specific date of retirement. So we always joke, green is good, you know, less risky, you know, having a professional look over that and manage it professionally versus doing it on your own. You know, red is risky, trying to build your own. If you're not comfortable with that, it may lead to non-optimal outcomes. So we also have a questionnaire that we kind of help you assess your tolerance for risk. You know, reach out to us if you think it's a good time to be looking at that. You know, we can walk through this questionnaire for you and find which portfolio would be appropriate for you, whether you're again investing in your company's 401k plan or you're an individual investor with us here. Here's our contact information. You know, again, if you want to reach out to us, Ryan, myself, Brian, Reese, we have 3 certified financial planners on the team available to you. We have additional financial planning tools that we would be happy to offer for you. If you need help with your investments, or if you want to meet individually in person at our office or through a Zoom meeting, you know, we're happy to get that set up for you. So with that, I'll just run through a couple disclosures. I want to thank you again for taking some time out of your day and meeting with us. We will have another call it'll be our 4th quarter call, which will take place around the 3rd week of January. And during that call, we will go over our 2025 forecast. So we hope you can join us. And again, appreciate your time. We're going to end the call today. And we'll hopefully see you in January. Take care.